Welcome back to FinScribble. If you are under 50, your entire investing life cycle was shaped by a single unspoken rule. Bonds are dead. For over a decade, central banks kept interest rates anchored near zero, turning fixed income into financial deadweight. Putting your savings into a traditional bond portfolio felt like stashing cash under a mattress that was slowly shrinking. Because of that environment, an entire generation of investors built a mental model that stocks were the only path forward. We poured everything into equities, embraced maximum volatility, and completely removed fixed income from our vocabulary. Holding 100% stocks was not just popular, it was mathematically logical when the alternative paid virtually nothing. But financial rules written during unique historical periods often disguise themselves as permanent truths. And right now, a massive macro shift just broke that 15-year baseline completely wide open. The 30-year Treasury yield recently hit 5.323%, marking a 19-year high point. Simultaneously, the 10-year yield pushed past 4.7%, piercing levels unseen by millions of active market participants. Think about what that actually means for anyone managing wealth today. For nearly 2 decades, capital preservation offered zero real return, forcing every investor onto the high-risk curve just to outpace inflation. Now, suddenly, the risk-free rate of return is screaming back to life. That yields are sitting at 2-decade highs is not just a statistical curiosity. It represents a tectonic repricing of money across global financial systems. If your default portfolio strategy was coded during the zero interest rate era, your baseline assumptions are officially outdated. The underlying foundation beneath your assets has quietly rearranged itself, demanding that every modern investor pay very close attention to fixed income once again. To understand this shift, picture 2 modes of transportation. Stock investing is like riding a wild, looping roller coaster. It delivers stomach-churning drops and thrilling peaks, but you accept that extreme volatility because it carries you up the mountain faster. For years, bonds were a stationary bench sitting next to the ride, paying 1% while you watched the coaster fly past. But today, bonds are no longer a wooden bench. They are a smooth, continuous express train running on parallel tracks right beside the coaster at 5% guaranteed speed. Suddenly, you do not have to endure terrifying 30% market drawdowns, earnings misses, or tech crashes just to generate meaningful investment growth. The express train moves at a steady, reliable pace without the violent stomach drops. For the first time in a generation, risk-free income offers a genuine, high-speed alternative to riding full volatility. This dynamic directly changes what finance professionals call the equity risk premium. Historically, investors expected stocks to deliver around 8% annually over long time frames. When government bonds yielded just 1%, taking full equity risk gave you a massive 7 percentage point premium over that safe baseline. That trade was an absolute, effortless no-brainer. But when guaranteed government yields climb to 5%, that equity risk premium shrinks dramatically, down to around 3%. Ask yourself, is taking on full market drawdowns, company bankruptcies, and sudden crash risks really worth an extra 3% over a guaranteed yield? For many long-term investors, the underlying math no longer automatically favors taking maximum risk. When the hurdle rate for risk-free assets rises this high, stocks must work dramatically harder to justify their place in your portfolio, completely altering how smart money evaluates risk versus reward today. A 100% stock allocation was entirely rational when bonds paid next to nothing, but keeping that strategy without updating your core assumptions is a dangerous trap. Behavioral finance shows us that investors tend to fight the last war. We get comfortable with the environment we grew up in, mistaking temporary economic conditions for immutable laws of nature. But financial history shows that market regimes shift in long, multi-year cycles. What worked seamlessly from 2009 to 2021 was built on cheap money and artificial interest rates. Today, ignoring fixed income means turning down cash flow while accepting uncompensated portfolio volatility. Reevaluating your strategy is not about panicking or declaring that equities are dead. It is about recognizing that your portfolio's default setting was programmed for a world that no longer exists. A mature strategy evolves whenever macro fundamentals experience a permanent shift. So, what does this mean for your money going forward? You do not need to abandon stocks entirely or flip to an overly conservative position overnight. Instead, it means recognizing that fixed income is once again a powerful, productive engine inside a well-structured portfolio. Whether through short-term treasuries, bond funds, or simple cash yields, securing 5% guaranteed return lets you take smart, calculated risks elsewhere without risking everything you have built. Capital preservation is finally paying you to wait. If you have never held a bond before in your life, now is the time to ask whether your asset allocation reflects today's economic reality or yesterday's fading memory. Take a close look at your holdings, run the math independently, and build a portfolio designed for the world we live in today. Thanks for watching FinScribble, and let us know down in the comments how you are adjusting your investment portfolio. As always, appreciate you hanging out today. See you in the next one.